Welcome back to the Global Ledger. I'm Justin. So far, in call it Arc 1, we've explored risk premiums, yield curves, Eurodollars, and FX swaps. We've laid out the core architecture of the global dollar system. Today, we're reaching to one of the deepest pillars of the entire structure, and that's collateral. I call it the real anchor of modern finance. Collateral is quite the foundation beneath repo, shadow banking, derivatives, the things we've been talking about, central bank operations. Collateral is what allows institutions to borrow, lend, hedge, leverage, settle, and create money-like liabilities. Most people think that the financial system rests just on cash. But the truth is the system rests on collateral, and cash settles collateral flows. Let's dive in. So let's start out with what collateral really is. Collateral is a promise to secure a promise. Collateral is often explained as something pledged against the loan, but when you look at it in a different framework, collateral is something deeper. It's a promise that guarantees another promise. So a treasury bond doesn't just earn interest; it serves as a funding tool, a settlement asset as well. Corporations don't post cash when they borrow from markets; they post collateral. Dealers don't lend based on trust either. They lend based on collateral. So collateral is the call it the hierarchy in action here. Why treasuries? You guys, we hear this all the time. Treasuries. Treasuries are the ultimate collateral, and not all collateral is equal. The market ranks collateral based on a lot of things. Just to name a few: liquidity, probably one of the most important, credit quality, haircuts, clearly dealer appetite, and repo ability is another one. And at the very top sits the U.S. Treasuries. This is the world's premier collateral, and because treasuries are safe, they're liquid, and really eligible for repo everywhere, and just really recognized globally across the board. So treasuries are not just government debt; they are the base collateral of the entire system. You could even call it the base layer of the collateral system, but. So this is why treasury markets matter even more than Fed policy. So let's talk about collateral chains. Collateral chains is basically when one bond supports many loans. And it gets interesting here because in the repo market, collateral can be rehypothecated. And what this means is it's reused by the lender to secure its own borrowing. So a single treasury bond can support one repo transaction, then another, through multiple institutions. So this is what's called a collateral chain. And in normal times, chains get longer, liquidity improves, leverage grows, and spreads tighten. Funding becomes cheap. So this is quite the growth engine of the system. But in stress, these chains start to shorten. Everyone wants the same collateral, and the system starts to deleverage, if you will. So, and this is kind of how crises can start. And because treasuries are the best collateral, they are always in demand. But the supply of usable collateral is not the same as the supply of treasuries. So some collateral is locked away in portfolios, held by central banks, or even parked as reserves at custodians. So the effective supply of collateral is much smaller than the total outstanding stock. So this creates collateral scarcity, and this can also lead to lower repo rates, tighter funding, flight to quality dynamics. And global dollar shortages too. So collateral scarcity is the heartbeat of call it shadow banking stress. Collateral and the shadow banking system run on collateral, not deposits. So the sequence you can have in your mind is that an institution pledges collateral in repo, it receives cash, and then it buys more securities, and it pledges newly acquired collateral. And this is kind of just the repetitive cycle. The structure is hyper efficient. It's of course hyper levered and hypersensitive to collateral quality. So when collateral is abundant, the system can expands. And when collateral becomes suspect, like in 2007, 2008, or scarce, like the Treasury shortage we saw in 2020, the system contracts. So the shadow banking system breathes, call it through collateral. So let's talk about collateral crisis for a second. So how do they actually begin? Financial crisis. So banking crises specifically used to be about deposits. Modern crises are about collateral. 2008 wasn't triggered by, say, deposit withdrawals. It was triggered by collateral failure. When AAA-rated mortgage bonds lost their status as safe collateral, this led to a series of events. Repo lenders refused them. Haircuts widened. Forced selling began. These chains started collapsing, and liquidity pretty much vanished. And then you started to see dealers failing, and markets were just melting. So this was not a traditional bank run. It was a collateral run, and we saw a similar dynamic in 2019 with the repo spike. The 2020 COVID, they call it the dash for cash, and also in the UK in 2022 we saw something, and also of course the recurring Japanese liquidity squeezes. Those are some examples. So collateral quality is the real systemic risk. So the central bank kind of steps in as the collateral backstop. So when collateral fails, liquidity fails. And then when liquidity fails, funding fails. And of course, when funding fails, well, markets go right with it. So that's why central banks step in, not to bail out asset prices, but to stabilize these collateral markets. So the Fed does this by buying treasuries, say, for instance, QE. So lending cash against collateral in repo facilities, accepting broader collateral in crises, offering standing repo facilities, backstopping the money markets, of course. And another example globally would be coordinating these swap lines that they have in place. So every one of these tools is a collateral support mechanism because the system itself is built on collateral. So what is this? How do we meet in the middle with finance and valuation and markets and this effect? So let's talk about those core principles again, or some of the core principles of valuation. Valuation depends on cash flows. It depends on growth. It depends on discount rates. It depends on risk premiums, like we've talked about in the past. Collateral affects all of them, every single one. And why is this? Because collateral influences the funding conditions. It influences the repo rates. It influences treasury yield, liquidity, hedging costs. It goes on and on. So when collateral is abundant and stable, discount rates fall, and these risk premiums start to compress. And what happens when this, the natural effect is valuations rise. And when collateral is scarce or unstable, the opposite. Discount rates rise, risk premiums start to widen. And this is where you'll see a fall in valuation. So collateral is one of those hidden variables in valuation that can sometimes be overlooked. So I think understanding collateral paints a different picture, and in a really, really predictable a picture as well, because most people see finance as unpredictable. And granted, no one has a crystal ball, but once you see what collateral is, how it moves, and how dealers rely on it, and how funding reacts to it, the entire system starts to become logical. So it doesn't look magical or political or mysterious. It's just mechanics. So that's why collateral understanding, I think, is an extremely powerful tool that you can have. So thanks for listening to episode 15 of the Global Ledger. We uncovered some real foundations of modern finance, not cash, but collateral. In episode 16, we're going to take this understanding global back to the global stage. And we're going to talk about the global dollar shortage and why the world always needs dollars. That episode we will tie together our euro dollars episode that we had, our swaps, our repo, and then collateral into one unified framework. So once again, I'm Justin, and thanks for being here.